Hello, and welcome to this short video tutorial on bank reconciliation statements and introduction. First thing we're going to look at is, what is a bank reconciliation statement? Well, a bank reconciliation statement is a summary of banking and business activities that reconciles an entity's bank account, the bank statement, with its own financial records, the bank account, or the cash book. So just from the point of view of terminology, the records that come from the bank will be called a bank statement, and the records that we keep in our own ledger accounts we will refer to as a bank account or a cash book. The statement outlines the deposits, withdrawals, and other activities affecting a bank account for a specified period, and the period is usually a month. The reasons for preparing bank reconciliation statements. Well, a bank reconciliation statement is the process of verifying the integrity of data between the bank's records, i.e. the bank statement, and a business's own financial records, i.e. the bank account or the cash book. So this will be the records within the ledger. It begins with matching the balances in a business accounting records for a cash account, i.e. the bank account and cash book, to the corresponding information on a bank statement. Now, this is just a quick view of what we might see. So, if we ran a business, we would have a bank account in our cash book. So this is a ledger account, and it is our transactions with the bank. So you can see here, 1st of March, an example here, we have £2,500 in the bank. 1st of March, we make sales, and we lodge another £5,000 into the bank. You note that they're on the debit side because this is money we have in the bank. It is an asset. The bank is a debtor. Meanwhile, down in the bank's records, there's the opening balance, £2,500, that's the exact same. We lodge in money, and it goes in the credit side. It goes on the credit side because we are creditors. From the bank's point of view, this money here is a liability. They owe the money to us. We are creditors of the bank. So, in the bank's records, they are recording the transactions with a creditor, so it goes on the credit side, and in our records, we're recording the transaction with a debtor. This is an asset in our records, so it goes on the debit side. Now, we'll just have a look at a few other little things here. Some terminology. So this is just quite important to get this clear. A current account, that's the main business bank account. Check clearing, or check clearing in American English, is the process of moving cash or its equivalent from the bank on which a check is drawn to the bank in which it was deposited. So the checks physically move through the system, and that's referred to as check clearing. A bank overdraft is an extension of credit from a lending institution that is granted when an account reaches zero. The overdraft allows the account holder to continue withdrawing money even when the account has no funds in it, or it has insufficient funds to cover the amount of the withdrawal. So with insufficient funds there, so basically it is a short-term loan or an extension of short-term credit. Direct debit is an instruction from a customer to their bank authorizing an organization to collect variable or fixed amounts from their account. So for instance, if you ran a business and you had an electricity supplier, you might sign a direct debit and they would collect the money from your account every month. The amount would go up and down each month as you use more or less electricity, so they can collect variable amounts. A standing order is an automated payment method set up between a customer and a bank to send payments to other people or organizations. Usually they're fixed payments. So for instance, if you had to pay rent and it was €500 per month, you'd set up a standing order to pay €500 per month, and it means you'd never have to worry about forgetting it. A credit transfer, a direct payment of money from one bank account to another, usually done electronically these days, but In some banks, it can still be done as a paper credit transfer. A dishonored check, a check that is returned unpaid by the bank on which it was drawn due to lack of sufficient funds. Sometimes this will be referred to as a bounced check. And then finally, the bank statement, which we've already touched on, is a summary of financial transactions that occur at a certain institution during a specified time period. For example, a typical bank statement may show your deposits and withdrawals for a certain month. So, just moving on here, the need for a bank reconciliation. Well, a bank statement will be received from the bank. The balance on the bank statement should be compared with the balance on the cash book, the bank account, in the ledger. So these are our own records. The two balances are not likely to be the same. They will more than likely disagree. The balances will be different. So a reconciliation is carried out to verify that the balances are correct. Why would there be differences? Well, reasons for the differences could include items that are in the bank statement but are not in the cash book. So we are missing information from the cash book, information such as automatic payments through the banking system, which we hadn't recorded, bank charges, and dishonored checks. So all of these items would be recorded in the bank statement, but we would not be aware of them. And secondly then, items that are recorded in the cash book but not appearing in the bank statement, such as unpresented checks. We've written a check and sent it to someone, but it hasn't cleared through the banking system yet. Or uncleared lodgements. We've made a lodgement, but it doesn't appear in the bank statement. So, we're going to have a two-step approach to doing our bank reconciliation statement. Step 1. Each item in the bank statement needs to be traced to the cash book in order to identify all items that appear in the bank statement but are not in the cash book. All such items should then be entered into the cash book and a new updated balance calculated. So basically, in step number 1, we're looking at things that appeared in the bank statement that we didn't know about, and we are updating and correcting our own cash book, i.e. our own bank account in our ledger account. And then step number 2, each item in the cash book should be traced to the bank statement, so to identify bank deposits and checks drawn that are not appearing in the bank statement, because the former are waiting clearance and the latter are yet to be presented to the bank for payment. The bank reconciliation would look as follows. So this is just a little example of what it might look like. So bank reconciliation statement, we'll start off with a balance per the bank statement. We will add in lodgements that we have made, but they haven't appeared in the bank statement. Now, they represent money that is actually in the bank, it just hasn't actually been put on the bank statement yet. And then we take away our less unpresented checks. This is money that we've actually spent. We've sent the checks to people, but they haven't put them through the system yet, but this money is actually gone. So we have the balance for the bank statement, plus the lodgements, less the unpresented checks, and what we end up with is a balance as per our corrected cash book. If the balance per the bank statement and the balance per the corrected cash book, or you could say the updated and corrected cash book, are the same, well then we've no worries. We can explain all the differences. If they're not the same, well that means that there are errors in the system which will require further investigation. So, just to conclude, there are a number of bank reconciliation questions and solutions available, and details are in the description box below. Thank you very much, and I hope you found this beneficial.